It's very different to build a product than it is to build a business. You need the product, but your go-to-market and how do you get those first few logos to lend credibility, and how do you get the pricing right, and all of those facets are incredibly important. And that's where I think we play a key role in shortening not just the sales cycle, but in avoiding mistakes and getting the right customers, the right ICP at the right stage.
We talk along similar lines at Air CFO about the fact that you really need to set a strong foundation from the early stages if you want to build a billion-dollar business. And mistakes that you make on day one, even if they seem like they are just minor shortcuts that you're taking, that operational debt can compound over time and can lead to things blowing up as the company starts to scale, which is obviously like the worst time for something to start breaking.
The founders. I have been on journeys with my founders where the market opportunity was okay, not particularly exceptional, and they managed to build multi-billion-dollar businesses and continue to expand their footprint and their market and their TAM. I've had others where they had the wind at their back and yet somehow could never quite capture it. So for a lot of the AI and automation and productivity, execution overrides everything else.
Hey everyone, welcome back to Funded. I'm Alex Wittenberg, and today we're going deep on what it takes to build an AI native company that won't get commoditized with one of the original VC investors in the AI space. Rudina Seseri is the founder and managing partner at Glasswing Ventures, where she's been backing AI-enabled enterprise companies since 2016, well before 2023's ChatGPT moment. She's led investments in companies like CrowdTwist, which sold to Oracle, and Xylotech, acquired by Terminus. And with over 20 years of experience, including time on Microsoft's corp dev team, she brings a unique perspective on what separates AI winners from others. In this conversation, Rudina breaks down a critical distinction that every AI founder needs to understand: the difference between being AI-enabled and AI-native. As she puts it, using AI to generate 80% of your code is now table stakes. It's a check-the-box minimum. The real question is whether AI gives you an edge that creates 100x value as opposed to incremental improvement. We also dig into Glasswing's incredibly thorough but fast-moving investment process, which allows them to evaluate 5,000 companies a year, ultimately investing in about 15, and lets them go from first meeting to term sheet in as little as 2 weeks. Rudina shares exactly how they run parallel diligence tracks and shares some pro tips on how founders can best navigate the diligence process. Plus, we talk about the two-way street of founder-VC relationships, including what founders should be asking investors during the fundraise process. And if you're a first-time founder, you'll want to hear Rudina's warning about treating fundraising like a one-term negotiation focused only on valuation. She claims that's a rookie mistake that she sees founders make far too often. I've really enjoyed this conversation with Rudina. I think there are a lot of great tips for founders in here, and I'm excited for you all to hear it. So let's go ahead and dive in. Thank you very much for hopping on with us today. I'm really excited for this conversation, and I think we're going to cover a lot of really interesting ground.
And thank you for having me, Alex. I'm excited to be here.
I would love if you could give an overview of Glasswing and an introduction to how y'all think about venture investing, and what about your investment thesis separates you from other VCs who are playing in the enterprise AI space.
Oh, happy to chat a bit about that. So we formed Glasswing Ventures in 2016 with a mission to back companies that were leveraging and are leveraging AI and frontier technology to drive transformational change in the enterprise and cybersecurity markets. So we're often referred to as an originalist AI investor because we've had that vision around AI investing. And in particular, we often look for companies that sort of control their AI technology stack at the middle layer and application layer. So software companies, but really with a differentiation and a right to win, if you will, by leveraging AI that have a transformative impact, like I said, in areas of vertical AI. So supply chain, manufacturing, financial services, insurance tech, construction in the recent past. So we have theses in those verticals, as well as areas around productivity and automation, oftentimes lending themselves to functional type platforms, i.e., helping developers become more productive, all the way to other functions, sales engineering, and beyond. And then about a third of what we invest in are cybersecurity companies, which are also AI or frontier tech native, but really solving that defense piece of the enterprise. And then from a stage and differentiation point of view, we are oftentimes the grand majority, the first capital in investors, so pre-seed and seed. And really what I'd love to believe, and I do believe fully, our differentiation lies in not just the fact of how deeply technical we are in both identifying the cutting edge technologies in AI and beyond, but really how operational we are in supporting our companies. It is not uncommon that during the diligence process, we bring prospective customers to the company and have often closed one or two of those customers for the company. And that starts at that moment and continues all along the journey of the company. We are active investors. We take board seats. We don't just invest in the Series Seed for our core investments. We continue to support them through the A, the B, and beyond. So it's a high conviction, high concentration, high support model.
Yeah, that's really helpful. I was looking at your website and saw the deep bench of advisors that y'all bring to the table, which must be so beneficial for early stage founders, especially highly technical founders who might be world class at building a product, but might need some help actually building a business or landing their first customers, or whatever those other aspects are of building a world-class startup.
Yeah, and Alex, to that point, I think you make an extremely astute point, which is it's very different to build a product than it is to build a business. You need the product, but your go-to-market and how do you get those first few logos to lend credibility, and how do you get the pricing right, and all of those facets are incredibly important. And that's where I think we play a key role in shortening not just the sales cycle, but in avoiding mistakes and getting the right customers, the right ICP at the right stage.
We talk along similar lines at Air CFO about the fact that you really need to set a strong foundation from the early stages if you want to build a billion-dollar business. And mistakes that you make on day one, even if they seem like they are just minor shortcuts that you're taking, those that operational debt can compound over time and can lead to things blowing up as the company starts to scale, which is obviously like the worst time for something to start breaking. And so, yeah, that really resonates. And I think that is a really wise approach to take as an early stage investor, really helping companies to fill in all of the pieces around the strong technical expertise that they're probably bringing to the table. You mentioned in your initial pitch that you are looking to invest in companies with a strong aspect of differentiation. I'm curious to hear what that means to you within the context of AI, because the shifting nature of the software development landscape it seems to mean that some of the technical moats that existed in the past are being eliminated, or at the very least like lessened. So I guess, how do you think about identifying companies that are going to have that sustained differentiation going forward in an age of AI?
Yeah, that's a very, very important question. So allow me to introduce two concepts to address that. One being this notion that every company, every software company going forward will be AI enabled. And AI enabled both on the input side and on the output side. What I mean by that is, if you are coding and, somewhere in the neighborhood of 80 to 90% of the code is not being generated by using AI, I would be concerned about the efficiency of the development team. That is a huge shift to how we were building code even 2 or 3 years ago. So that's sort of that AI enablement on the input side. On the output side, I think we would be hard pressed to find companies going forward where the UI and UX won't have a human-like interaction, an intelligent-like feel, i.e., AI being leveraged. And those two pieces are absolutely important components. By the way, AI can be leveraged not just for development, all sorts of other functions within the enterprise, but I'm using that as a very concrete, tangible piece. However, those two pieces are must-haves. They're check the box. They will not set you apart from other companies. You absolutely have to have them or you will fall behind, all else equal. Where we at Glasswing, given our focus around AI and frontier tech, believe that there is a moat, if you will, around AI businesses, it's really around this new notion of AI native companies. And what I mean by AI native companies is companies that control their stack. And I referenced this a little bit as I was giving a description of Glasswing and the opportunities we look after and seek. But it's really companies where at the core of the software, at the core of the product, they're leveraging AI architectures and algorithms, and they have unique access to data. So that's sort of a piece of the technical moat. But the moat extends more broadly. These companies go in and are solving problems that you couldn't solve at all, and most certainly not solve well with run-of-the-mill software. So there's something about the role of AI and the ML that goes in and the learning and the improvement that creates value that cannot be replicated with run-of-the-mill software. And the reason that's really important is because building an AI native company is not an easy exercise. So if you can go and build it with run-of-the-mill software, by all means, go do that. You don't need AI. But if AI, gives you a huge edge, and the impact, the last piece of that mode is, multifold over ROI, not just in time saved or slightly better improvement in productivity or cost, but literally, orders of magnitude improvement, then all of a sudden you have an AI mode and a business mode. Now, that's not to say that there won't be companies that just have a wrapper around them that will not succeed. It's just that those companies will not necessarily succeed on account of AI nativeness. They may succeed because they have a better UI. They may succeed because they have a hook to the customer base, other switching costs. For Glasswing's focus, though, we really look for AI nativeness at that middle layer, application layer of the stack. They can use any third party foundation layer or LLM or infrastructure, software infrastructure layer, but really they're capital efficient because they don't need as much compute, and then they have this sort of nativeness for an area where there is incredible value creation and very hard for incumbents to respond.
I definitely agree with your point about the value creation from AI being most obvious in areas where AI is enabling companies to do things that weren't possible without AI. I think the first level of evaluating AI opportunities is like, what can AI let people do more efficiently? But that's really not where the 90% of the value of AI is going to come from. I think it's going to be enabling companies to do things that just weren't possible in a pre-AI or with a pre-AI infrastructure. And we're thinking about that at Air CFO as well, trying to shift our mindset from how can AI make us more efficient to how can AI enable us to do things that we just couldn't do before.
What's the edge, right? It's one thing to be more efficient. It's sort of like saying today, hi, I'm a startup and I'm a SaaS model and hosted in the cloud. Would all be like, oh, great. Tell me again, where is your edge? Like, that's table stakes. I think the efficiency piece of leveraging AI is and will become table stakes. The real question is, where is your edge and how does incorporating AI into your product set really give you an edge that others cannot respond to or cannot respond to as easily, and from a competitive angle, and then from an adoption angle that creates so much value for the customers that when the next so and so comes in, even if they have some improvement in technology, the value you've created is so fundamental that it makes the switching costs much higher.
So I'd love to talk a little bit about the process that you and your co-founder have built at Glasswing for evaluating and investing in these world-changing AI startups. Could you walk us through what the typical investment process looks like, from the very first interaction that you have with a founder to ultimately offering up a term sheet?
Happy to. Important to note, as a precursor to outlining that process, that at Glasswing, we are thesis-driven investors. And what that means is that in any given space, supply chain, manufacturing, insurance tech, whatever the category might be, we already have a view of where the opportunities lie in that category, not in terms of identifying the players, albeit competitive landscape and knowing it is quite important, but sort of like there is a green space or there is a space ripe for disruption, such that when we're evaluating opportunities, it's not as if we're just waking up and hearing about a brand new market that we need to come up the learning curve. And I think that's important because when we are then evaluating opportunities, we know the dynamics in that market, we know the forces, we know who to leverage from both the advisors, as you mentioned. It's almost 60 advisors at this point that are exclusive to Glasswing, and the trust network that's a broader circle of hundreds and hundreds of people in our community. So that's an important precursor. And then we try to be pretty disciplined about that because, as I like to say internally, the less I know about a space, the more I like it because I don't know where the words lie. So at any rate, but let's assume that it's an opportunity we're evaluating in a thesis area that we have a view and are interested in investing. From that moment, the overall process, from a first meeting to a term sheet issued, varies as little as 2 weeks and as long as 4 or 5 weeks. The more typical process, I think I would say, is around that 3-week mark, give or take. But, I will describe it in broad brushstrokes. There are exceptions all the time in one way or another. But typically, we have someone, a senior associate, a principal, someone from the team that takes that first 45-minute to an hour meeting with the founder, sort of quickly aligning, is it on strategy? Is the stage appropriate? Does the founding team pass initial muster? And then sort of reorganize ourselves such that if that meeting goes well, then we quickly make a decision who would be the right partner to sort of sponsor that process and become involved. The second meeting typically involves that partner, and provided it goes well, and this happened in a matter of sort of days from each other, in space at most, then we stand up the team, and the team runs along several paths. So there's the core team of the partner, the more junior person. We have a second partner involved with the deal, and we sort of call that a little bit of a checks and balances. You meet founders. I find them extremely inspiring, and sort of you don't want to fall in love with just their energy and whatnot. You want someone to keep you in check. So it's almost like that second partner plays a role of, have you thought about this risk? We're not addressing this risk, sort of like a check and balance. And we do that for every opportunity, for every company we're looking at. So you have that kind of core team. And then in parallel, we have a go-to-market team. So we have our operating partners who have sales, marketing, and product DNA that meet with the company in parallel. And then we have another partner who's really focused on the tech, is the AI nativeness, truly AI, does it truly native rather, does it scale appropriately? So we run these three paths in parallel. And provided all is going well, then we continue to advance, go deep on the opportunity set, competitive, do analysis, market sizing. Keep in mind that I'm looking for opportunities that are multi-billion. Why? Because, if you don't have that opportunity set, given how early we go in, typically it's the two or three founders, a couple of developers, maybe a couple of design partners, most likely none. So it's a lot of risk taking that occurs. So we have to do a lot of work, both on the competitive landscape, but also if we build it, will they buy? So we go out to our advisors, we go out to our trust networks to really start identifying potential buyers, customers. Who else have you seen? And oftentimes make those connections. I view it very much as paying it forward with these companies and sort of getting feedback. So that process is a very iterative process. And every beginning of the week, every Monday, we have a partner meeting that focuses purely on the pipeline and of opportunities. And we go through each opportunity and either advance it to the next stage or conclude that the risks are too high, something doesn't work, the appetite might not be there, and pass on the opportunity. I will share that the best thing a VC can do, in my humble opinion, outside of actually investing in the company, is deliver a fast no. The worst thing one can do is give a prolonged no to a company because they're resource limited. I mean, I have my own portfolio companies. When they go for the Series A and the Series B, you really appreciate a yes, but the second best appreciation is for a quick no. So we're very mindful of that. And unfortunately, the no's get really tricky when the company is borderline. You really don't want to let go, but you may not be able to get them through the finish line because of all the issues that might have come up. Those are, areas where we guide our team to really make the tough decisions. Because again, out of good intention, you do not want to drag that, those conversations. Give them a chance to go have fundraise with others. So I'm mindful of that. Provided all goes well, we get to a stage where, again, if there are companies or customers rather, we leave that as the very, very, very last step. And I would advise every founder, do not give your customer references if you have them early in the process. Insist that it be the last step, because you can imagine you're talking to 10, 30, 50 VCs, I don't know, however many, but if we all put calls, wait a minute, those are your precious few. So be very protective of your customers. From my end, we're very mindful of that. That's a sort of final step. And in parallel, we're getting to know the founders. It's not a requirement, but we love to meet them in person. Oftentimes, we will go to them as much as they will come to us. And then start also discussing, terms like valuation and board structure and other expectations. Here's another sort of area to highlight during fundraising. It is very interesting to me because first-time founders view their discussions and really their negotiations with the venture capitalists that are evaluating them as a one-term transaction, and that term is valuation. Experienced founders fully appreciate that it's a multi-term negotiation. And no matter how many of these chats I do, I think broadly they will fall in that category. But I strongly encourage founders, particularly first time founders, to also look at, protective provisions and what the board can and cannot approve, and the structure prefer of the preferred, etc. Because down the road they play up just as importantly as valuation does. So to bring it back to our process, we've done the back and forth, we've done references, and then we get to a term sheet, which, our IC has approved. And by the way, there's a lot of work that gets done internally. There's a full-blown investment memo, and we have a unanimous decision-making process, and it's a pretty flat sort of organizational structure internally. So provided that we've gotten to a yes, then we issue the term sheet. We go back and forth on the term sheet with the founders. If we've deviated from the range of approval that we have from the IC, we go back to the partnership, and this is all done very quickly. And provided we agree on the terms and the structure, we sign the term sheet, and then we move to legal documents, which is a 30 to 45 very rarely 60-day, but 30 to 45-day process. And we finalize everything and we wire. And that's the beginning of a long, long journey alongside these founders. And as we like to think internally, where we serve as an extension to the team.
Amazing. Thank you for the detailed walkthrough. That was so insightful. I have a couple of areas that I'd love to just double click into from what you just said. You mentioned the thesis-driven nature of your investing, which I really appreciate. And I think the majority of VCs are operating on some kind of a thesis, whether or not they want to admit it to themselves or not. So being upfront about it and being intentional about the types of opportunities that you're seeking out probably helps you to very quickly identify whether a founder is worth spending additional time with, or whether it's better to give them a quick no, which to your point is one of the best things that you can do for a founder if you're not ultimately going to invest in them. So based on the way that you approach seeking out investment opportunities, I'm curious, how many of your opportunities in your pipeline come through inbound leads from founders who are reaching out to you versus your team taking your thesis and going out and surveying the landscape to understand which companies fit within that thesis, and then you actually engaging them proactively?
That's a very good question. And in full candor, it changes dramatically, or even from quarter to quarter, which I always find fascinating because even in your articulation, you articulated it as two buckets. It's actually many, many, many more buckets than that. So I'll give you a couple of examples. We will often, we've built an AI engine internally, which feeds part of our sourcing, where we're looking at breakthroughs on AI and quantum and other areas and how they're impacting certain areas of the enterprise to see if there's a thesis alignment. And then, look at who are the people contributing to these breakthroughs, whether it's that particular paper that got published or commenting in reviews, and then tying that to their public persona and seeing if they're in stealth mode or I've just announced that they founded a company or some indication, and proactively reach out to those folks. So in that sense, that's a very, outbound effort. There are certain accelerators and incubators that we very proactively reach out to. So that would be outbound. By the same token, there's a lot that comes inbound, especially given the brand that we have built around Glasswing. So with this early stage AI and frontier tech focus and really value add in getting customers, oftentimes I find that our own founders are the best sort of sources for us in terms of bringing other founders. So that happens quite a bit. And there are other instances, Alex, where we have a thesis. We might have seen a couple of companies, but nothing really passed muster. We will incubate. Now, incubation is not for the faint-hearted of hearted. It is a lot of work, so we're very selective. I would say we probably do 1, 2, at most 3 in any given fund. But that's a form of sourcing, with repeat founders. And the gamut sort of runs from there. But I'm giving you some examples. I wish I could say it's 75-25 or 50-50. Even within the smaller buckets, they vary a lot. Sometimes there will be a lot of students that come to us because of an event, because of something that, content. Other times it's repeat founders from a certain vertical. So I actually find it quite intellectually stimulating to look at the data. I mean, just to give you a sense, over the last 4 quarters, we have seen almost 5,000 companies. And out of those, I would say we've invested in about 1 out of 300 and change of the companies we have seen. So it's a lot of them, and a lot of them get eliminated quickly. Back to, if you can't give a yes, give a quick no. And then the ones that we continue with is that time frame that I outlined. But there isn't a silver bullet to sourcing. Last point, I don't want us to get lazy. I'm, managing partner. I am out there sourcing as much as my associates and analysts and everyone in between. The moment that you lose that touch with what's happening with the founders, you will have very well-formed views that in the long term become stale. So very important to be in the ecosystem. I don't know, did I answer your question?
Yeah, absolutely. I can tell that you are very not data driven, but data informed when it comes to the different sources of leads entering your sort of top of funnel investment cycle. And obviously it's going to ebb and flow quarter over quarter, but it's really interesting to hear how you think about the different ways that founders come onto your radar. And you brought up a really interesting point around your investment funnel and the fact that from your description of your diligence process, it's clear that you go extremely deep with the startups who make it through that first call. But you're starting with this really large pool of potential investments, 5,000 companies a year. And so you don't have a ton of resource bandwidth internally to be able to move, say, half of those companies beyond the first call. So I'm curious, what would you say are the 1 to 2 key factors that determine whether a company is moved from the first call stage to that deeper diligence phase, based on your experience moving companies through the pipeline?
One quick point before I address that question. Yes, we can't graduate 5,000 companies to multiple stages. It's because there are resource constraints. Having said that, for an early stage firm, we're investing out of a second fund at Glasswing. We have a team of 15 people, so which is a lot bigger than most firms of our size, precisely to have an opportunity to see as many companies as possible, as well as add disproportionate value to our existing portfolio. So important to draw that distinction. Listen, in terms of your question, there isn't a one single criteria truly. However, if there was, that one would be the founders, and the founders. I have been on journeys with my founders where the market opportunity was okay, not particularly exceptional, and they managed to build multi-billion-dollar businesses and continue to expand their footprint and their market, and their TAM. I've had others where they had the wind at their back and yet somehow could never quite capture it. So for a lot of the AI and automation and productivity, execution overrides everything else. Now, I'm making it sound very absolute. In an ideal world, you want the execution, you want the big idea, you want, the differentiated tech and all those other facets that we discussed. But if I had to hone in on one, it's not even the size of the idea, it's really the ability to execute. That from meeting to meeting they said they would do X, and they got X plus something done. And then that's just how they are ingrained, and that hunger, if they're first timers, is the drive. If they're repeats, is both the drive and their track record previously. So it would come down to that. Even in their use of AI, how can I be more efficient? If I have 10 developers at some point, but 90% of the code is being AI generated, how can I redeploy those 10 to double and quadruple what I can build product wise? Is that the right balance? I mean, all sorts of different facets of that nature.
Yeah,
How can I
absolutely.
transform markets? How can I will go and conquer this market because my performance is 100x and I will settle for nothing less, and let me prove it. It's not just aspiring, it's substantiating.
One of the questions I had on my list was, how do you go about evaluating those qualitative factors as it relates to a founding team? And I'll let you weigh in on that. But one thing that you just mentioned that I think is very related is the follow through. So as you have multiple touch points with a founder, are they actually are they setting high goals for themselves and their team, and then are they able to go above and beyond those targets that they've set for themselves? So you're sort of able to map out this like trajectory, even if it's over the course of a short period of time, that gives you a sense for, is this person or is this founding team going to be able to scale into a large, like world changing company? So yeah, I really appreciate that point. And I think that speaks to the fact that all interactions between a founder and a VC are very, very important and worth like being super thoughtful about from the founder's perspective, because VCs are trying to make very high conviction bets on founders based on a relatively limited number of interactions in a lot of cases. So they really do need to be assured that the founder is going to be somebody who, like you said, is going to continuously raise the bar for their team and have that like really dependable follow through.
And I cannot stress that enough. In addition to that, though, important to know that this is a two-way street. It's not simply, me assessing the founders. They should assess us. Because we don't expect perfections. By God, I would be the last person to claim to be perfect. I have plenty of weaknesses, just like everyone else. The real question is, can we work together? Can the founders sort of execute? Do they take feedback? I am perfectly happy being told, no, I have the domain expertise, I will go down this route. And that's okay. But if they're for everything a no, I have some pattern recognition. So, if we're going to be in this, I think of it as a marriage, or sometimes if we're going to be in this marriage for decades, longer than some real world marriages, can the founder work with that particular VC? Can that particular VC work with that founder? So execution, again, I honed in and oversimplified to that piece with the founders. But then there are the softer facets. Will the VC be there for you when the going gets tough? One thing you love about founders is their deep belief in success. And, they're just a quarter or 2 quarters away from that, tipping point. Is that 2 quarters continuously shifting, or are you really there? And if you are almost there, but running out of money, where is your VC? Are they there for you? Or do they just sort of, call it a day and leave you hanging? When we're courting, everybody will say the right things. Go dig with their founders, ask to speak to companies that have actually failed in their portfolio. So I don't want to leave you and the audience with this impression that the high and mighty VC has arrived. They control the money. Be on guard at all times. No, get to know your VC, have some real conversations, even if you don't have as much optionality as you'd like with term sheets, even if you have one, get to know who you are becoming involved with, what are their strengths, what are their weaknesses, and how they can add value. I wish more founders did that, because it makes for much better journeys as they go through the ups and downs. I mean, for me, I really, really pride myself in being the first call for my founders. The worst that can happen is you show up in a board meeting and you are surprised for good or for bad. It tells you that your rapport with your founder isn't there. If I'm truly an extension to the team as I believe, and I'm closing a 400K customer for you, if an important customer churned or we had someone quit or something else happened, I hope I'm your first text message, Slack message, or phone call. If not, I've fallen short.
What would you say to, or let me phrase this a different way. What are some questions that you would encourage founders to ask during the investment process to get a sense for the relationship that they might have with a potential investor? Or what are some good questions that you've heard founders ask you that you think have really helped to demonstrate the potential founder investor fit?
Yes, some of those I already alluded to, but it's, how do you work with the founder? What is your style? You know, what should be our sort of communication style, frequency, how formal, how informal? Um, how do you react to bad news? How do you react to good news? The latter being probably an easier piece to have around the good news. Um, why do you think companies fail? How can we avoid those? When the going gets tough, what's your approach? Where have you made mistakes in the past with founders, dear VC? What have you learned? What can you pass on to us? How are you going to add value? I'll give you advice, I'll give you strategy. Great. Pontification is free. What are you really going to do for me? I mean, I'll give you an example again from the firm. So I mentioned to you that at the beginning of the week, we review the pipeline. At the end of the week on Fridays, we actually focus on our portfolio companies. And every time we discuss an existing portfolio company, we literally have a 2-pager. On the first page is what the company has done, traction, what they missed, where they succeeded, risks, that sort of thing. The second page is what has Glasswing done for them lately since we last had that discussion. And then I tell the team, just because we invested, we shouldn't expect a right to for them to deliver. We have to ask ourselves, how have we scaled with them and what have we done for the founder lately? So when we walk into a meeting, whether it's a board meeting or a casual catch up, we can actually believe in substance and in form that we've earned the right to expect. So we come very much with that mindset of what are we doing to support our founders and how are we pulling the training wheels? We can't be closing all their customers. So, once they start to build their own GTM with the go-to-market team, then we can focus on partnerships. Then we can focus on, follow-on capital introductions. We've done that part. Okay, then we can focus on sort of the banker process and introductions to bankers or potential strategic partners that might become acquirers, or if they want to go public, to start thinking about the board and who do we have as an independent, how we scale. So in every stage, there is something we can do to support them. And if we're putting our feet up, that's a real problem. And the funny thing is, you find yourself being tempted to not help the top performers at all, to really spend your time in the bottom performers because they need the most, when in many ways, with a VC hat on, where you really want to be is bring the bottom up, but really focus in that middle layer to push them to the top. The temptation to go and solve the problems of what I call problem children is quite high, and no VC escapes from that, yours truly included. But really, you got to add value to all of them, just proportionate to the impact that you can have and the companies can have on your portfolio overall.
You've talked a lot about the post-investment cadence between Glasswing and your portfolio companies. I'd love to just hear a little bit, like, tactically, what does that set of interactions look like on a week-to-week, month-to-month basis? Like, how many times are you touching base with your founders? What sort of information are you asking them to provide to you regularly? And just in general, like how do you think about the two-way street of communication between the founder and the VC after you invest?
Truly runs the gamut. I'll start with the more formal and get to the more casual. And perhaps the easiest thing is to pull up my Slack channel or my text messages and be like, here's one. But the more formal is there's quarterly reporting, because we in turn have to report on each company to our underlying investors. And that's fairly automated. And, if you're going to preach automation and AI, you better, do so, follow your own advice. So that's a very automated piece. It goes to the founders, it touches on the various facets of the business, try to make it as as mainstream as possible and as scaled as possible, because they don't have time. And this is not a value add exercise for them. Then beyond there, you have the board meetings, and oftentimes board meetings range in frequency from every other month to once a quarter. And in between those, I have the more formal touch points, less formal than a board meeting, but I guess firmed up touch points of every 3 weeks or so, sometimes every month, sometimes every 2 weeks. It kind of depends, but every 3 weeks is probably a steady cadence. In between, oh goodness me, I mean, like this morning, I was texting with a co-founder and head of revenue, checking on the status of the signature for a customer that we've been waiting on, and they're kind of running behind. And then I made another customer introduction that had gone quiet for a bit, that just came back. So there was a lot of back and forth on the pipeline. With another founder right before this call, I guess 2 meetings before this call, not quite right. We were going back and forth on the financing and term sheets and structures for their follow-on capital, and that was all done over text. Prior to that, we had another conversation that was a standing conversation for my 8:30 call. I kind of like to have those on my drive in and the founders drive in, so we're not taking away from our business day. And some discussion around the new hiring we need to make, and some changes to the competitive landscape. So it runs the gamut, but it requires this ability to, you roll in with that company and then you step back, you go to the next, and a lot of multitasking. But you've just had a flavor for my typical day, and it knows no limits. I'm smiling because something came to mind, which I don't often share, but here I go. I have a daughter, and when she was about 4 or 5 years old, the phone rang at midnight, and it was one of my founders. His name is Paul, and she'd gone to sleep. She was young, upstairs in her bedroom. And when I hung up, I hear this little voice, "Mommy, mommy." And I say, "Hi, are you up?" She's like, "Yes, I heard you talking. Was that Paul?" And the person's full last name, so full name. And I'm thinking to myself, oh my goodness, like I do so much work at home and bring it home with no limits, that my 4-year-old knows first and last name of the founder CEO of the company. So it tells you something about how all encompassing this role is. Done as I do it, there are different approaches to it.
Yeah. Sounds like your daughter might be a future venture capitalist there. She's already got the founders' names dialed in.
I hope she's
That's a
a
really great
founder. I
story.
think it's being a founder is a tough journey, but it's such a gift. I mean, I'm a founder of my own firm, so I know firsthand what that feels like. It's extremely rewarding, and it's the only career where if you fail, it's not held against you.
Well, thank you for running me through your cadence with your portfolio companies. The thing that stuck out to me about that is you have your preset recurring touch points through the board reporting and the board meetings, and your every 3 weeks more formal, like standing one-on-ones. But then it sounds like you're also fielding a lot of inbound from your portfolio companies, and I think that speaks to the depth of your relationship with those founders, that they are reaching out to you. And that's actually something that we really try to stress to founders, is like your VCs should be a resource that you tap into, like like on a regular basis, because they can really add so much value. They're not just there to wire you the money and then, go back off to their offices and, you hear from them once a quarter. Like, you should be communicating with them on a frequent basis, tapping into them for connections to potential customers and partners and advisors and all that kind of thing.
Yeah.
So,
Put us
um,
to work. Put us to work.
Yeah.
We're
Yeah.
already in. We've already wired the money. Why not get full leverage?
Yeah. All right. I have two last questions for you. The first one is related to how AI is going to impact the venture investing space on a more like meta level. So obviously you invest in a lot of AI companies, but I'm curious to hear, as someone who's been in the industry for so long, how you see advancements in AI shifting the dynamics, maybe around like the math behind a venture fund, or like the decision making process that goes into investing in startups. Just like with all companies leveraging AI, like how does that kind of change the way that VCs will be evaluating opportunities in the future?
So, a couple of thoughts in that regard. One being that the later stage the VC is, the more automation I expect to see. The reason being is that there will be a lot more data and a lot of ways to mine that data and deliver productivity. So, as you pose the question, the applications of AI and AI related tools and products for a growth stage firm are quite different than for an early stage firm. Early stage firm, especially first capital need, there is a lot of asymmetry of information. I have to imagine that there are two or three founders somewhere that have decided to come together. I referenced earlier that there is some AI capability that we already have built around the sourcing engine. So I expect that to continue to grow, albeit not in the same discovery level of someone who is investing in the Series B or the Series C, where there is an abundance of data. So important to draw that distinction. I think there will be a lot of productivity from thesis to competitive landscape discovery to estimating markets. A lot of the legwork that gets done to evaluate an opportunity. I think there will be a lot of automation of that work through agents and otherwise. There's already that. There's a lot of sort of the intelligent worker, the intelligent investor will not be doing all of that from scratch. They will become a lot more interpreters of outputs rather than amalgamators and interpreters of the output. So we should be able to see a lot more productivity. Will there be a quant approach to early stage investing? You assign values, and we have a little bit of that, albeit not something that I'm ready to brag about, at least not just yet. So I see some opportunity. I don't have a well-formed view as to how impactful. What I will say, though, at the meta level, is that from here on, it's a human machine symbiosis. Make no mistake about it. It's not simply crunching numbers, albeit in early stage. How many numbers are you truly crunching? But, to go with that proverbial expression, it's not that. It's going to be a full sort of intelligence collaboration where you can really get to be more thoughtful, dig deeper, more valuable in your assessment, and then also how you add value once you are in. So I certainly expected to play a big role. How big and how it relates to each stage of venture investing will vary, is my humble opinion.
Yeah, that's a really good answer. I mean, yeah, for the later stage, they obviously are going to have the ability to be much more quantitative and just kind of dump a ton of data, both provided by the company and sourced from like third party signals to help them make investment decisions. But at the early stages, I think at the end of the day, it is going to come down to your judgment of kind of like the founder's gumption and the ability to raise the output of their team, and some of those things that are a little bit harder to feed into an AI algorithm, at least today. So
And though you can automate a lot of the other facets of business building, from the opportunity set to the competitive analysis, there's a lot that you can largely generate with agents in combination with each other. And and get to those outputs much faster, apply the human piece to it, and then focus on other facets that you previously might not have gotten a chance to focus on, even if it is getting to know the founders better.
Well, we're right at time here, and thank you so much for being so generous with your time. If it's okay, I have one last question for you that I think would be a good capper to this conversation. I mean, you've given a lot of really great advice to founders about how they should be approaching their fundraise process. I'd love to hear what you think or what you see as being the number one pitfall that especially first time founders tend to fall into when they are setting out on their fundraise journeys. And then, along with that, like what would be the one key takeaway or piece of advice that you would want someone watching this conversation to come away with?
Okay, so I think on the pitfall, I'll go back to it's not a one-time negotiation, and be careful what you wish for. Yes, the higher the valuation, the smaller the dilution. That is very clear, and your negotiation and the VC are absolutely on other sides. No ifs or buts about it. However, play the vision out a few rounds. Where do you want to end up by the Series B? What does that imply traction wise? Where do you therefore have to be by the Series A? What does that imply traction wise? What do you have to achieve between the Series C and that valuation that you hope to have in the Series A? And then you can throw that analysis out. But it's an incredibly important valuation exercise to go through, so you realize the bar you set for yourself. Because if you're going for a high valuation and can keep that momentum from round to round, by all means, absolutely. But if you can't, you've put a company which you might have done just fine in terms of traction, but you set the valuation so very high that it makes the next round extremely difficult to raise. So don't just be focused in that moment. Much like you have a vision for building a large company, go through that exercise. And then, in terms of sort of what to keep in mind, or remember what your North Star is. You are doing what you are doing as a founder and building a business because you fundamentally believe in it. Don't let go of that belief. Be wise about it, take feedback, but you are the one who's building the business, not the VC, not the advisor. Hold on to that dream and be grounded in execution.
That's really great advice. And I mean, I totally agree with you about I think it's a really useful exercise to model out one or even two rounds into the future and kind of work backwards from that to help visualize what needs to be accomplished with the funding that you're trying to secure today.
And perhaps if I may add something, Alex, that I failed to mention, also ensure that you have the stage appropriate VC for each round, because someone might be less sensitive to evaluation because you are a drop in the bucket relative to where their focus is. But will you get what you need out of them? Really important and not spoken about as much as it should be.
Wow. Well, thank you so much for dropping all this wisdom on us today, Rudina. It was really great to speak with you and learn a little bit more about how Glasswing invests in world changing early stage founders. And I think you've shared a ton of useful, tactical pieces of advice that founders will be able to take to more successfully put themselves on the radar of company or firms like Glasswing and ultimately successfully raise their rounds so that they can get back to building. Really appreciative for your time and for your team's time in setting up this conversation. And I'm really looking forward to continuing to follow along with all the great content that you're putting out about AI and applying that within Air CFO and within our portfolio companies as well.
Thank you, Alex. It's a privilege to work with founders. So this is the least I can do. And thank you for having me on the podcast.
Anytime. All right. Have a great rest of your week, and we'll talk to you soon.